Welcome to Financial Insights in Minutes, where we summarize the day's top financial videos for you.
Today we're diving into the turbulent housing market and exploring its impending challenges.
Are we on the brink of a market crash? We'll discuss alarming trends such as skyrocketing prices and decreasing sales.
Join us as we unveil insights from leading experts that can impact your investments.
Stay tuned for the summaries of key videos that highlight what to watch for next. First, Real Estate Mindset warns of systemic fraud and economic collapse risks. Next, Ken McElroy discusses the housing supply crisis and the impact of corporate investors. Wright reveals shocking June home sales data and comparisons to the 2008 crisis. Grant Franke inspires with strategies for replacing W-2 income using rental properties. Jason Walter analyzes shifting inventory and mortgage rate trends affecting buyers. Lastly, Christian Bauer explores creative financing solutions for real estate investors. Welcome back to Real Estate Mindset. Today's explosive topic is the looming collapse many are predicting in our economy. Joining us is the insightful Mitch Wexler, president of Mockingbird Properties. Sit tight because we're diving deep.
Absolutely. Mitch brings an incredible wealth of knowledge, having dissected the current property appraisal and mortgage landscapes for years. Get ready for some eye-opening revelations.
So what's the burning thesis in today's discussion?
Mitch argues that systemic fraud within appraisal districts and inflated debt-to-income ratios could potentially spiral the economy into a deep depression. Many households are already on the brink.
Let's dive into some shocking statistics, shall we?
Certainly. Mitch reveals that 37% of households are at risk of losing their homes, while 64% can't afford their housing. Plus, the appraisal data? A staggering 76% is reportedly corrupted.
And what's the deal with debt-to-income ratios?
Great question. While the maximum DTI should be 43%, a lot of mortgages are pushing that to 56.99%. In 2018 alone, about 957,000 mortgages exceeded these limits.
Wow, and it doesn't stop there. What about the appraisals?
The evidence points to a 40% inflation in home values. This manipulation is feeding into a broader financial crisis of extreme distress.
Looking to the future, what dark forecasts does Mitch have?
He predicts that if these fraudulent practices continue, it could trigger a massive economic collapse, especially in the housing market.
As we wrap things up, what are the crucial takeaways for the viewers?
Mitch emphasizes the urgent need for reform in property appraisals and accountability in the mortgage industry. Ignoring these red flags could lead us into a full-blown economic depression.
What's the call to action here?
Viewers need to stay educated and informed about these financial intricacies. It's essential to take action to protect their assets and advocate for transparency in appraisals.
Welcome to Ken McElroy's YouTube channel. Today, we're diving into a hot topic that's been sparking debates. Is BlackRock really inflating home prices, or are they just an easy target for politicians trying to explain why homes cost so much?
This discussion is crucial, especially given the skyrocketing prices in today's housing market. Ken McElroy, a seasoned real estate entrepreneur, is here to illuminate the real issues at play.
So what's the main thesis of today's video? What's really causing the surge in home prices?
Ken argues that the primary problem isn't corporate investors like BlackRock, but rather a severe lack of housing supply and difficult regulations hindering new construction. This makes for a tricky market for first-time buyers and renters alike.
What are the key takeaways about housing supply?
Ken emphasizes that a lack of new construction and stiff government regulations significantly limit housing supply. With the population growing, this problem will only escalate.
And what about corporate investors? Are they really the main ones to blame?
Not quite. While firms like BlackRock do have an influence, they're only buying around 3% of homes. Most buyers are still individuals or small investors looking for rental properties.
Interesting. What recent developments should homeowners keep an eye on?
Ken notes that states like Ohio are considering legislation that could tax corporate landlords. This might impact how investment properties are managed moving forward.
What's the takeaway regarding rental properties?
The more corporate landlords engage in the rental market, the higher the likelihood of increased rental availability. This could provide relief for families struggling with skyrocketing home prices.
As we look to the future, what predictions does Ken make?
Ken predicts that the ongoing population increase will continue to push demand for housing, even as rising interest rates may create added disruption within the market.
And what about governmental interventions?
Ken warns that evolving regulations and zoning issues may complicate the recovery of the housing market as municipalities try to balance affordability with local interests.
To sum it all up, what's the main takeaway from Ken's insights?
Ultimately, Ken asserts that the challenges plaguing the housing market center around inadequate supply rather than solely corporate investors. Addressing the supply issues requires thoughtful government action and community engagement to pave the way for more homes.
Welcome back to another great episode on Melody Wright's channel. Today, the focus is on the startling state of June home sales. Spoiler alert, it's worse than 2008.
Indeed, Melody, with her wealth of experience in the mortgage industry, breaks down the wild happenings in the housing market and commercial real estate. Hold on tight.
What's the crux of Melody's alarming news?
The key thesis here is that June home sales completely shattered the seasonal expectations, reflecting not only declining sales, but also a stressed consumer base grappling with financial realities.
Let's dive into the key points. What's happening to home sales?
Melody highlights that existing home sales saw the worst June figures in 25 years, with combined metrics sinking below those dark 2008 days. That's a major red flag.
Yikes! What's causing such distress among consumers?
We've seen over 30-day delinquency surge. Consumers are barely keeping afloat with rising costs associated with home ownership, indicating clear financial strain.
What about inventory? What's the story there?
Interestingly, while inventory is on the rise, sales are plummeting. Motivated sellers are starting to pop up as they can't afford to hold on to their homes anymore.
And the pricing dynamics? What's going on?
In a twist, new home prices actually reached higher than existing homes, but in June, we hit an all-time high for median prices overall, adding to the confusion.
What's the sentiment like among buyers?
Consumer sentiment is historic low right now for home purchases. Stock market fluctuations are impacting perceptions, leading many to rethink their options.
What predictions does Melody foresee for the market?
Melody predicts significant ongoing declines in both sales and prices due to consumer distress, which will likely compel further adjustments in the market.
So what about sellers? What can we expect?
As financial pressures mount, expect an uptick in motivated sellers in the market. This could lead to long-term changes in inventory strategies.
To wrap things up, what are the concluding thoughts?
Melody compellingly argues that the housing market is in serious trouble, with consumer stress manifesting in abysmal sales and an uncertain pricing future. We need to keep our eyes peeled.
Welcome to BiggerPockets. Today's exciting topic: how can real estate replace your W-2 income? Joining us is Grant Franke, a savvy investor from Nebraska who's done just that. Get ready for an inspiring journey.
Absolutely. Grant shares his powerful story of transitioning from a railroad conductor to a successful real estate investor. With dreams of time freedom, he's scaled his portfolio tremendously. Buckle up for some incredible insights.
So what's the core idea here? What's the big message from Grant's story?
The main thesis is that through strategic investments and planning, real estate can provide a reliable source of income, ultimately allowing individuals to leave their traditional jobs behind.
Let's unpack some key points. How did Grant get started?
Grant began his real estate journey in 2016 after realizing he wanted more family time. By 2019, his investments generated enough cash flow to replace his W-2 income.
That's really impressive. What about the financials?
He calculated needing about $4,000 monthly, aiming for around 42 doors to replace his income comfortably. It's all about smart cash flow management.
And how did he break into investing?
He jumped straight into buying a duplex. Multifamily properties help mitigate vacancy issues, ensuring steady cash flow even if one side isn't rented.
Financing is crucial in all of this. What was his approach?
Grant utilized saved cash and loans against his 401k. With strategic financing, he's amassed about $8 million in real estate assets.
Looking ahead, what does Grant foresee? Any predictions?
He emphasizes a cautious growth strategy, focusing on building relationships which will lead to future off-market deals.
So wrapping up, what's the essence of Grant's journey?
Grant's story shows that with careful planning and strategic investing in real estate, financial freedom is truly attainable. Those looking for a roadmap should dive deep into education and relationship building.
Welcome back to Jason Walters' channel. Today, we're diving into the latest trends in the housing market, and boy, do we have some eye-opening insights.
Absolutely. With mortgage rates dropping and inventory levels shifting, it's a wild ride for homebuyers and sellers alike.
So, what's the crux of today's discussion? What's shaking up the housing market?
The core thesis is that despite lowering mortgage rates, pending home sales are plummeting. This strange combination is leading to record price reductions, happening at an odd time of year.
Let's kick things off with mortgage rates. What's happening there?
Mortgage rates have dropped to 6.77%, the lowest since March. But even with that drop, the typical homebuyer is still paying around $2,700 a month.
And what about pending home sales?
Pending home sales have decreased by 5.7%, the largest drop in about 9 months. It seems buyers are taking a cautious approach given current economic uncertainties.
Inventory levels are also shifting. What's the latest?
New listings are up 6.1% year over year, and active listings are hitting a 3-year high. It's a mixed bag for buyers, as there's more to choose from.
And how are these shifts affecting affordability?
Home prices remain near record highs, costing buyers an extra $1,000 a month compared to 2021 payments. Ouch!
Interesting. What's the general sentiment among buyers?
Many buyers seem to be waiting until fall or winter, possibly driven by concerns about political and economic instability. Time will tell.
What predictions can we make about pending home sales?
If uncertainty persists, further downturns in pending sales seem likely. However, if economic signals improve, we could see a shift in buyer sentiment.
And what about the balance of the housing market?
With inventory rising, we could be moving towards a more balanced market, offering buyers more leverage in negotiations.
So, to wrap it all up, what should buyers keep in mind?
Buyers should exercise caution as the market shifts. Falling rates and rising inventory are positive signs, but affordability challenges remain a concern.
Any last nuggets of wisdom for our viewers?
Certainly. With the market evolving, strategic decision-making is key. It's wise to stay informed and ready to act when the right opportunities arise.
Welcome back to BiggerPockets. Today's topic could change the game for real estate investors struggling with debt-to-income ratios. Joining us is the exceptional Christian Bauer, an expert mortgage broker who knows all the ins and outs of creative loan options. Buckle up.
Right. If you've been told you can't get loans because you're self-employed or have too many properties, you're in the right place. We'll show you how to unlock financing without the typical W-2 constraints.
So, Christian, what's the crux of today's discussion?
The main thesis is that creative loan products exist for investors and entrepreneurs who might not qualify based solely on their W-2 income. It highlights stable and sound options that can help propel their real estate journey.
Let's dive into the key points. First up, can you explain what the debt-to-income ratio is?
Sure. For conventional loans, the typical DTI threshold is between 45 and 50%. FHA loans take it even further, allowing some borrowers to exceed 55%, which is quite forgiving.
What are some creative solutions you mentioned for those facing DTI challenges?
There are several. For self-employed individuals, bank statement loans allow qualification based on cash flow into their bank accounts rather than tax returns. And DSCR loans allow cash-flowing properties to qualify instead of the borrower.
How does this system prevent issues like those seen in 2008?
Great question. Today's lending requires income verification and often 20 to 30% down payments, which significantly reduces the risk of default compared to the past zero-down loans.
So, what's the prediction for the future of creative loans?
Creative financing options will continue to flourish, providing diverse opportunities while keeping the housing market secure. It's about innovation within safe boundaries.
All right, what should viewers take away?
The big takeaway is that there are numerous creative loan options for those hitting DTI roadblocks, enabling more investors to achieve their real estate dreams. Don't shy away from exploring these.
Any final thoughts on community engagement?
Absolutely. We'd love to hear from you. Leave your questions and experiences in the comments. Let's keep the conversation going.
In this video, we see our guests' unified concerns about the housing market's troubles.
While Wexler speaks about widespread fraud jeopardizing stability, McElroy stresses housing supply issues.
As Wright warns of sinking sales reminiscent of 2008, Frankie posits that real estate offers an avenue to financial freedom. Thanks for watching Financial Insights in Minutes for July 30th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.